Most people aren't fully aware of the risks involved in switching super funds, and unfortunately some of these risks can be very costly. In today's video, I'm going to explain to you 5 risks in rolling over your super, including simple actions you can take to eliminate these risks. I'm Chris Strano, the founder of Super Guy, the place where Australians go to maximise their super and plan their own retirement. If you're new here, make sure you click that subscribe button and all the links related to this video. Remember, this is general advice only. Please read the disclaimer in the link below. Alright, let's dive in. Now there's a number of reasons why you might be rolling over your super. You might be looking for cheaper fees, better returns, more investment options, more estate planning flexibility, better insurance options. Whatever your reason is, that's up to you. In this video, I'm going to give you a few things that need to be considered prior to rolling over your super. Things you might not have thought about, kind of like a bit of a checklist for you to tick off to make sure that you've considered it. And let's get stuck right in. So risk number 1. If you have any insurance within your current super fund and you roll over your total balance to a new fund, you will effectively be cancelling your existing insurances when the account closes down. Now, it is possible that your new fund offers automatic acceptance insurance and you will be automatically covered once you open up a new account, but you definitely want to check this out because once you cancel insurance cover, it can be very difficult to get new cover, especially if you're getting older or have had health issues and so on. Because if you need to fill out any insurance applications and you've had health issues, any new insurance might be more expensive. It might even exclude certain conditions, or the insurance company might completely decline your application. Whereas any insurance that's already in place usually can't be cancelled by the insurance company, even if you've had major health issues. So keep an eye out on that one. Now, if you do want to keep your existing insurance, you can either keep your full balance with your current super fund and not roll over, or you can simply leave a portion of your super in your existing fund and roll over the remainder. This way your insurance remains in place. You just want to make sure you keep the balance topped up so it doesn't run out of money to cover your insurance premiums. The only real downside of having 2 super funds is that it adds a tiny bit of complexity because now you're running 2 super funds instead of 1 and maybe slightly more fees because you're paying 2 administration fees. But it might be worth keeping it open just to keep the insurances in place. This is quite common. Risk number 2. When you make a personal concessional contribution to super, otherwise known as a deductible contribution to super, and you want to claim a personal tax deduction for that contribution, you need to notify your super fund of your intention to claim a tax deduction and how much of the contribution you'll be claiming a tax deduction for. So this is done by filling out a form and submitting it to the super fund, and you'll then receive confirmation from the super fund that they have recorded that amount as a deductible contribution or concessional contribution. If you roll over your super to a different fund prior to notifying your current fund of your intention to claim a tax deduction and then receiving that subsequent confirmation from them, then they'll usually just say, bad luck, you didn't tell us it was a deductible contribution, so we record it as non-deductible contribution, otherwise known as non-concessional contribution. And now that you've rolled over your funds to a new fund, it's too late to change it. And the reason it's too late is because they would have provided your new super fund with the components of your super balance. And once that's done, it's locked in. So be very mindful of this because it could cost you thousands in extra tax. Risk number 3 is time out of the market. This one is important too. So basically when you roll over from one super fund to another, your current super fund needs to sell down the investments within your account and then tick all their boxes before they roll over your funds to a new super fund. Your new super fund then needs to process your rollover application and invest it into your chosen investment option. Now, this could easily take up to a month to roll over your super, and this means that your super might not be invested for an extended period. Could be 2 weeks, 3 weeks, 4 weeks, even longer. This means that no distributions, no dividends are received during that period and no capital growth either. You might be lucky and the markets could crash during your rollover and you weren't affected because your balance was being transferred, but that would just be lucky. So time out of the market is something to be very mindful of also. Risk number 4, transaction costs. Depending on how your super is invested in your current fund and how your super will be invested in your new fund, there may be transaction costs such as buy-sell spreads, brokerage, switching fees, withdrawal fees. You need to be aware of all these costs prior to rolling over your super, especially if you're switching super purely to save on fees, because it could take, 3, 4, 5 years of fee savings just to cover the transaction costs that you incurred in rolling over, for example. You can check the product disclosure statements for your current fund and your proposed fund to see any costs that will be incurred. It's all detailed in the PDS. And finally, risk number 5, chasing investment returns. If you're moving super funds because your current fund, the ABC fund, hasn't performed as well as the XYZ fund, and you want to move to the XYZ fund because last year they had stellar returns and they won, Money Magazine's Super Fund of the Year or whatever, you need to understand the risk of this, because just because a super fund performed well last year, it doesn't mean it will perform well again next year. There's also a number of ways that super funds can have a cracking year or two followed by a few years of lower performance. And one way is that many funds, industry funds, have the ability to perform investment smoothing through reserve accounts. And what this means is that when they have a good year, they might tuck away some of those earnings into what's called a reserve account and then bring them out in poor performing years to stabilize the returns over the period. Or they might tuck away some earnings into the reserve account for a couple of years so that they can have one really good year. Another thing to consider is that many super funds hold huge illiquid investments, such as infrastructure projects, and they might not be getting them valued regularly. So an infrastructure investment might have dropped in value, but because it hasn't been revalued, it appears the super fund is valued at more than it really is. For example, imagine that you didn't get your share portfolio valued the year before or the year after the COVID-19 crisis. You wouldn't actually know the real value of your portfolio throughout that outbreak. And this is how it works with many super funds, because some of their major assets aren't valued every day or every month, so returns can appear to be better than they really are. All I'm saying is, don't get too caught up in chasing the bright lights of shiny returns, especially if those stellar returns were only for a year or two. Well, there you go. I hope you enjoyed this video on the 5 risks of rolling over your super. Can you think of any other risks? If so, comment below. Also, make sure you like, share and subscribe for more videos on superannuation and retirement planning. If you're looking to build your own retirement plan, then I highly recommend checking out our premium program, the Super Guy Hub. Head over to superguyhub.com.au. Thanks for watching, and I'll see you on the next one.